Hello, everyone. Welcome to this week's episode of ClueCon Weekly. Joining us this week is a, personality from the venture capital world, Floyd from Storm Venture, founding partner and manager. And thank you for joining us, Ryan.
Hello. Nice to be here.
And it's a little bit of a departure from the usual technical and open source people we have on the show usually. So, first of all, if you'd like to give us a quick introduction about yourself, what you've done, what you do.
Sure. Yeah. So I am, as you mentioned, I'm a venture investor. I started Storm just about 23 years ago, and we're investing out of Fund 7 today. So I feel a bit like a dinosaur. I've been doing venture for a long time. We just focus on investing in B2B companies. So that's to say companies that sell to other business buyers. So I don't fund anything that has a consumer end user. Well, consumers may be end users, but not of the companies that I'm funding. We don't do any life sciences. We're not doing any crypto. So we're very focused in what we do, and we're typically investing in companies that have some customers already. Typically, they're $500,000 or more in recurring revenue. Typically, when we invest, and we can get into a little bit about the strategy if you're interested as we get into the talk. But that's a bit about me.
Yeah. So the first question I have is just a simple one. What does it mean that you are on fund number 7? Because I've never truly understood how it works.
Yeah, I think there's sort of a practical implication of that, and then some kind of implied things. So the practical reason is that venture funds raise money from LPs. They're typically pension funds or high net worth individuals, family offices, corporate investors that commit capital to us, and the fund has a life where we tell our LPs, there's a fund term to that in which we will dissolve the fund. They'll be released of all capital commitments, and we will distribute all proceeds out of the fund. And that fund life is typically 10 years is the standard, but it goes usually longer than that, where we have some extensions and so forth that I won't get into the details of it, but it's a fairly long period of time. But our new investment period on each fund is typically 3 years. Okay, so we'll raise a fund, we'll make new investments out of that fund for a period of 3 years, and then if we want to continue to invest in new companies, we'll need to go raise a new fund to invest in the next crop of companies. So as a result, you get fund 1, 2, 3, 4. They start kind of stacking up over time. And we have very few companies now. We have no companies in Fund 1. We have no companies in Fund 2. We've completely wound that up. There's one company that I'm involved with in Fund 3 that I've been on the board of for 17 years, a long time. The company's done very, very well. But we'll definitely need to exit that in the very near future. And then with Fund 4, Fund 5, there's obviously more companies than getting to Fund 7. So that's the way it works. The implied thing that I referenced is that we've done fairly well as a fund. So LPs, maybe at the risk of stating the obvious, are willing to continue to invest in our funds so long as we're generating returns for them. So we've been fortunate with the Storm funds that we've been able to generate top quartile returns, and they've been willing to continue to entrust us with their capital.
So the idea is that eventually each fund is kind of like its own venture capital investment. Like it's funded by money. You invest in companies, and at some point you exit all of them. In fact, your first funds are empty at this point. So
that's right. I mean, they all exist as unique tax entities. And if you were an individual investor in one of our funds, we would be sending you what's called a K1. So for Fund 2 and Fund 1, there's no more K1s. There's no tax filings on them. There's no assets. They're completely wound up and closed down. But then for the subsequent funds, and you can think of them as kind of discrete entities. And you could raise one fund, and that's all you ever do as a venture investor, and that would totally work. Or you can raise 100. I don't know funds that like Mayfield and so forth that have been around forever, or NEA. I actually don't know what fund they're on, but it's probably approaching 20. If it's not already up to those sorts of numbers. Definitely well into the teens.
Well, I have so many questions. So maybe one thing we could just another clarification because before we delve into the meat of what the Storm does is what's the difference between a firm like Storm and someone like well they're big but Berkshire Hathaway, so someone who's doing value investing because some people sort of mix them up. I've
Yeah.
sometimes heard them mentioned that it's not the same thing.
Well, I could talk about obviously there's a ton of differences, and I could talk about it for an hour, but I'll try to really put it in kind of simple terms. A firm like Berkshire Hathaway does do private equity, so they invest. They will buy companies. They will take them over to private. They'll also make public investments. Um, uh, so Berkshire is kind of a unique entity, and it's unique because of their structure and lots of things that they've done um, with that. But they have a pretty large purview. But I would say in general, what Berkshire is trying to do is they're really not trying to take a lot of risk on high growth businesses. So if you really to boil it down, they're going to make management changes, they're going to improve operations, but fundamentally, like the whole Berkshire mentality is, which is a good one, we're going to buy great businesses. Because if we back great businesses with great managers, those companies are going to do really well over time. And Buffett and Munger have done a really good job of figuring out those companies and obviously paying the right price
Yeah.
to get in as well, right? Which is your value investing comment. What we're doing is, we're sort of almost on the other end of the spectrum, where we are very high risk investing. Many of the investments we make will fail, and our success as a fund depends on a number of those investments doing extremely well. And we are generally taking a ton of risk with respect to a market, often with a team, first time founders, often with technology, although maybe not so much these days. I don't consider there being a lot of risk with software as compared to maybe semiconductors or other deep tech ideas. But there's certainly a lot of execution risk, no question. And we then get rewarded for that risk with very high growth, high performing companies when things work. So it's a very different strategy. I mean, I'll just give you one other point. I mean, they're investing in mature businesses. They spend a lot of time crawling through financials. We're investing in companies that maybe have a $500,000 to $1 million in ARR, and we'll certainly look at the numbers, but it spend some time there understanding the business. But there's not a lot to dig into just because the businesses that we're investing in tend to be far less mature.
So yeah, you could say that value investing is looking for 5%, 10%. They're looking for 10x.
That's right.
That's pretty
That's
much.
right. But I think what's important though, Luca, is that's right. They're looking for teens kind of IRR. We're looking for investing in companies where you could get 100x, where you could get massive IRR return. But ultimately, our fund returns may only be marginally better than Berkshire Hathaway on an aggregate, because those 10x or 100x opportunities, right, are averaged out by the companies that don't necessarily do as well. And our investors expect us to generate a higher return than if you bought, Berkshire Hathaway stock. And the reason for that is when you commit to my fund, you're locked up, as we just talked about, for 10 years.
Yeah.
Right? Your capital, it's a commitment. Like you can get out of the fund, you can sell your fund commitment. We could, that's a whole nother topic, but it's not liquid. It's generally speaking, you can assume it's very hard to sell. So once you commit, you're in. So there's kind of an illiquid premium that people expect because, hey, if I can get the same return going and investing in Berkshire, well, I should just go do that because I can just buy public stock. If I need to sell it, I can sell it. Everything's transparent. I don't need to deal with this crazy venture stuff. So to do well in venture, you need to be able to drive better than average returns.
Well, then the literally $1 million question: how do we get noticed by Storm Ventures? Say I'm someone who came up with a nice idea. I have the right ARRs. What are you looking for in a potential investment?
So I got a call from another investor who had spent a lot of time with Tony, and that investor knew that I had a lot of interest and a bias to doing technical investments, and we talked about it, and I got introduced through him, and I met Tony, and kind of the rest is history, I suppose. As I got involved that way. So that's how it came on my radar.
And well, someone looking for an opportunity, like say, if I had a startup, how do I go look for a venture? Is it really just word of mouth? You need to know people. Is there a way to get into the? Because I feel like many friends I have had trouble looking for funding more than anything. Not even getting the funding. Like not talking to you. You evaluate and say, no, we're not going to invest in this because these are not getting to people like you, like being able to show them.
Yeah, yeah, it's great. It's a great question. And I've got a YouTube series called Ask a VC, and I've published at least one or two videos on this because it's I think founders get very frustrated. They get a lot of no's, and they don't get to the right people. Um, Again, we can talk about it for a while, but just to give you a few salient points, I think the first thing that founders need to do is to really make sure that they are targeting the right group of investors. Because, like you just asked a question about Berkshire Hathaway, I think venture investors appear to many to be all kind of the same. I'm the same as anybody else. I'm a venture investor. We all do venture investing. So what's the difference? Well, it turns out, like most things, there's a lot of nuance and there's a lot of differences when you really get into the details. And so for me, for example, as I just mentioned, I just do B2B investing.
Mhm.
Still to this day, I get emails almost every single day from founders raising for consumer businesses. Okay.
Oh,
And regardless of the merit of their idea, I'm not going to follow up on that because it's outside the purview of what we do as a
the
fund.
wrong
Right?
email.
So it's a high pass filter. They just targeted the wrong people, right? So the first job for founders is to really target the funds that are investing in their space and at the right stage. This is the other one that founders get wrong often. They'll send notes to seed funds that only invest, for example, as the first money in. This is a common refrain of a lot of seed funds. Or we'd love to take a look at your business, but we only do first money in. If you've already raised a little bit of seed money, well, then don't target those folks because they're not going to be a fit, right? So also, if you have no revenue, you have no customers, I'm not a good fit because I'm looking for businesses that have a little bit of revenue, right? So figuring out then the stage and the space that an investor invests, that's job number one. Once you've done that, I think uh, speaking with and getting to know other founders that have successfully raised money, those intros can be great. And it doesn't mean they have to be people that you went to high school with or from college or you worked with or something. I think most people sometimes are surprised to find that, founders, I think generally want, especially if they've been successful, want to help other founders be successful. So I think talking with other founders about, what you're doing and whether they know investors that might be interested, that's a great way to do it. Uh, Targeted email to me, if I get an email, a cold inbound that fits my strategy, B2B investing or a space, half a million in ARR or more, I'm very likely to respond to it. Like, I respond to cold emails, and I don't think I'm unique. I think, it's not all investors, but, a lot of us will respond to cold emails if they're targeted and appropriate. Um, so I think that's another good way to do it. So talking with other founders that have raised money, and cold emails. I mean, that's a really good way to start.
So
I
don't
think
be
that
afraid to reach out.
if you move outside of founders, then I think you can go to other executives that maybe at tech businesses that are maybe connected to venture or no venture investors. So you start kind of expanding, that way. There is no silver bullet to do it. There's no directory and matchmaking service or something. But yeah, those are the strategies that I think work really well.
Well, yeah, that's but in the end, the network is very important. So, well, there's another thing. I knew you were coming on the show. There's been one question that I've been thinking about, which is the bad side. So you've had a lot of investments that went well, and we know Storm has done very well. But when you see an investment falter, what has not worked in general? What do you think is the most common way for a startup to not work out?
It's almost, well, again, it may sound like I'm stating the obvious. It's almost always execution.
Hmm.
Almost always execution. Um, Sometimes companies will get market timing wrong. They'll be too early to a market. They had the vision right, but they entered the market really before the market was ready for what they had to sell. And if you get market timing wrong, that's very, very tough to solve. But execution is the most common problem, and it's not an easy one to solve. I think finding the right team at the right time for a business can be hard, because the team that can be really successful at building a business to 10 million in ARR, which is no small feat, is going to be a different team, likely some members of the team at least, that are going to be able to build it to 200 million in ARR, right? And so getting all of that right along the way um, is pretty tough. And I think a lot of the founders that we back, and I think again, it's not unusual, or unique to us. I think most founders tend not to necessarily have a ton of management experience, and so a lot of the challenges that come up in running a business are, it's sort of a new thing for a lot of them that they need to learn. And many learn very quickly and do an amazing job of figuring these things out. Tony's a good example, where, he's constantly learning and really trying to figure out how to do things that he hasn't necessarily done before and get feedback and do them better. But obviously some are better at it than others. So yeah, execution by far is what challenges most businesses.
Yeah, many of us. So on the show, we very often talk about developers. We are mostly developers, and I feel like myself included, we come from very highly skilled technical backgrounds. We're very good at what we do daily, but when you transition into management, even myself, I've been leading social architecture for a while now, and I had to learn a lot of things. Even if I ran a consulting company for 15 years, because management within a company is not the same thing as managing a consulting outfit.
That's right. Yeah, no, that's
Consulting,
right. It's a different it's a different thing entirely. Yep.
consulting, you just show up, do the thing, send the invoice, and done. There's no. Sometimes you hear from the customer again, unless you market to them and go ask, "Hey, give me that." But it's really very very different. So I understand that. So learning some management skills probably going to benefit a lot of people. Well,
I think too, since you mentioned developers, it's probably worth mentioning too. I think one thing that many founders struggle with is they typically come out of a technical background, an engineering background, or they come out of product often, and they get a little bit of seed money, and they develop a product, and all of a sudden then it becomes all about customers. It becomes all about selling. It becomes all about revenue growth, and especially once they start raising venture money. And I'm as guilty of this as anyone. Then the focus is entirely on the business rather than the technical components of the product, or what's coming next. It's all about the quarter and the year, and what the financial plan is.
yeah,
And that's really what businesses ultimately are measured on. And I think that transition too, it can just it's hard for many, because it's very unfamiliar territory. Going from really focusing on engineering problems and technical problems, or product issues, and maybe they're having conversations with customers, but they're not thinking about the go to market piece, about really how to scale that whole sales motion. But that's ultimately what will drive success.
yeah. I've heard the story about someone starting a small startup here in Italy, and they had a very good product, and they were speaking to prospects all the time. And when the time came to actually start selling and making money, they got a response from one customer that said, "Well, I said this will be a good idea, not that I will pay for it." So when they asked these
Oh,
customers, said, "Well, yeah, this would be great to have." But then when they went and said, "Well, now we have the product, it will be, I don't know, $100 a month, and it will do this and that," they say, "Well, you know what? We said it would be a good thing, but not necessarily that we will pay for it." And that stuck with me as something you need to be aware of.
yes, getting there's really no substitute. You're right, for getting customers to pay for something, because talk is cheap. And I don't think I've observed this over the 20 plus years. I don't think there's anything nefarious, like where customers are trying to mislead founders or whatever. They want you to be successful, and they want to talk to you about the product you're building, and they really don't want to be a naysayer or critical, because I think generally speaking, human nature is, people want to avoid conflict, right? They want to make friends. They want to cheer each other on. I think in general, and so that customer interaction, if they're not paying for something, it's very easy to hear back either what you want to hear, right,
Mhm.
and have happy ears, or just the customer is giving you very positive feedback, but it's absent, as you just mentioned, that
Mhm.
willingness to pay. Because when you have to pay, that person may have to go up and justify it to their boss, right? They may have to explain now what the value, why are we spending this money for this thing? And that person may realize they can't articulate it, even though they really like it. And all of that whole feedback loop is really important ultimately to getting it right in terms of really what that product market fit is.
I think what you just mentioned is the key part. Like you've been talking to their developers. If you're doing, for example, if you're building a SaaS idea, you've been talking to developers. They all say it's great. Then the developer has to go to their manager and say, "Hey, can we spend $100 a month on this thing?" And the manager looks at it and says, "Well, no, because we don't really need this." And that's where you take apart. It's
Right, right. And the developer, the person may not be willing to go to the mat on it. They don't want to expend political capital with their boss to get it. They'd love to have it, but it's a nice to have. Maybe it's not a gotta have, right? All those things kind of come into play. That until there's money exchanged, it can be difficult to read.
good. So, well, someone might have watched the show so far and like what they're hearing and thinking, well, what if I got into being a VC instead, or rather working for a VC firm? That's another
Yeah.
question I always had. Like, how does someone get to the other side of the mirror and start working in a VC firm?
I do get the question all the time. And uh, there is no clear path. If you look at successful uh, GPs of funds, you will find they have a very varied background. You'll find some GPs that say you should be a founder. That's the only way to be successful. You will find some GPs that say you have to have been an operator. That's the only way you can make it work. You'll find some that say none of that really matters. Like so it's really all over the map in terms of backgrounds. And I don't think there is one. I mean, the good news for people is I don't think there is one background that drives success. What I think is probably most important that I don't think is talked about enough is network. So there is no directory of opportunities to invest in, right? There's no clearinghouse. There's incubators, and there's programs like YC and so forth that people can go to. But but by and large, there's no way to access that. So how do you find opportunities to invest? Well, it's based on your network. And it's very similar in other areas too, like real estate investing, where there's no clearinghouse on many of those opportunities too. It's your network that presents those opportunities. So it's not just unique to venture. Um, but the 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 investment in that network is not something that's easily done like overnight. It's not like you can start at a venture firm and say, "Oh, I'm going to go build my network." So the first thing I would tell anyone that's thinking about being an investor is to spend a tremendous amount of time networking and really getting to know not only people in your company, but people in kind of adjacent businesses in tech, if that's your area, um, because that asset will compound over time, and and you'll be able to build it. But it's not something that's easily built in a couple of weeks of starting a new job. And I think that's what a lot of people struggle with when they come into venture. They have a very small, relatively small network, because the reality is if you're a great executive or operator or founder, it doesn't necessarily make a lot of sense to be investing time in a big network, because that doesn't really serve you well in your job function, right? So it's not a natural thing to be going to spend your time doing. So that's the first thing I tell people is really invest in the network, especially if you're young. Because I think as you get older, it's harder to build that network. I've found over the years that I think, what happens is, when I'm 51, as people get to be older, they tend to have a network. They're not as open and willing to go out there and meet new people. You kind of get, set in your ways or whatever. So when you're young, especially, I think that's a good time to be investing because everyone's looking to build their network then.
To play so much golf to network before it gets boring.
That's right. That's right. Yeah.
It's the
Um,
same.
the other thing I tell people is, thinking about something like venture is you got to be really committed and passionate about learning all the time because fortunately or unfortunately, it depends kind of, what drives people. But, you know, when I first invested, just take SignalWire, I knew a bit about VoIP. I knew the basics. I'd been in telecom years ago, so I knew more than most. But I mean, Luca, I mean, you would be over my head in 15 seconds if we got into any sort of details, right? Because I'm not as smart on VoIP as you all are, and that's true not just at SignalWire. That's true in every business that I'm in. So I have to spend a lot of time learning and really because I think it's hard to be an investor in SignalWire and not have some basis of understanding about how the business works and the technology that underpins it, right? So I
Yeah.
think people have to be really into that too and be willing to invest a lot of time, um, and just be excited generally about learning because it's not you kind of end up being in venture. People say a mile wide and an inch deep. That's very true in venture versus like what you're doing. You get the joy of being very deep and being an expert at SignalWire, and that's not really afforded to venture investors.
That's yeah. I think that with what you said at the start, I just thought is the mirror. So how do you find? So if I am a company, I'm looking for a venture capitalist. There is no investment fund. There is no directory of investment funds. Conversely, the same thing is works the other way. So as you said, there is. If I'm a VC, I literally have money in my fund. I'm not. I can't just sit there, put a sign on my door, and wait for people to ring because no one will. It's
That's right. No one's
it's a
gonna no one's gonna
finding
fall,
each.
and it's even a little harder than that because I think John Doerr, who's a retired partner from Kleiner, said this years ago, which I totally agree with. And maybe he wasn't the first to say it, but venture we're a service. I'm a service business. You know, my money is just as green as everybody else's, and so not only it's not that I just put the door my shingle up and my doors open. I'm waiting for people to ring the bell, but I got to convince people why me why work with me relative to somebody else just like you would in any kind of service business. So there's a whole added dynamic around that as well, especially for opportunities that tend to be a little bit more competitive.
Just getting money for a startup is important, but who you get the money from is also important, I think, because if it's the wrong fit, it's never gonna. I mean, it's better than no money, but if it's the wrong fit, it's not gonna help much. Like, say you decide to invest into one business to consumer company. I don't know why. You might just go crazy and you pick one. You paradoxically will not be able to help them super well, right? It will be a different
Yeah, no,
market.
I think you're right. You're right. I think a lot of people make the comparison that picking your venture investor is kind of like getting married. It's a big deal, and it's even harder or more challenging than getting married because you can't get divorced. There's no equivalent of divorce. In terms of like once you have people on your cap table, they're going to be on your cap table until the end of the business. That's not you as a founder don't get to decide to push them off the cap table, right? So I think it is a very important decision, and I think what you said is right on the money, which is it's a lot about a cultural fit and a personality fit, and it's less about I think the brand of the firm, and has more to do with that individual that you're going to be working with on a day-to-day basis because name I won't name any names, but like take some big firm that's $1 billion fund that has 500 investments. Those the partners at that firm don't know every invest. They can't possibly know everybody, right? So you're really going to be dependent on that individual that you're working with, and that's where you want to make sure that there's a good, really good fit.
Well, Ryan, I mean, this is so interesting, and I think we're going to have to do a part two with a few more questions because
For
it's.
sure.
I think people
Sure.
really. I think the climate is finally picking up again, looking good for startups. Things are moving. AI has energized the market a little, and I feel like there's going to be more questions coming. So looking forward to it. But for
Great.
now,
Yeah, we almost got through the whole time without mentioning AI, which was that's pretty unique in today's day and
yeah,
age.
it
Yeah.
is. It is really. So, yeah, we'll make next week. Next time we talk, we'll talk about how to use AI to not make investments. Like, please don't do that.
How AI is going to replace my job. Yeah.
I don't think so. I'm very skeptical. Every time I've seen people say, "Oh, I have trained an LLM and now I can predict the markets," I've seen them not. I mean, if they break even, they're doing good. So might as well just buy a single ETF from Vanguard. It's actually much better than using AI right now. I don't know what the future holds, but for now, Ryan, thank you so much for joining us today.
All right. Okay. Great to talk to you.
Ryan Floyd, co-founding managing director of Storm Ventures, joined us today. We talk about VCs and all the aspects of getting to a VC, and conversely, how VCs fund companies. And I hope we're going to have another chat in the future. So thank you so much again, Ryan. For the rest of the people, see you next week. Goodbye.